Now, why use superannuation to save for retirement? It's a very good question. And this table tries to, from a tax perspective, communicate why superannuation is a beneficial place to hold your retirement assets. Now, if you look at investing money, there are 5 broad structures in which you can invest, and superannuation is just another structure in which you can invest. It's not an investment in itself, it's a structure, and then you choose what investments you put in within that structure. So if you invest in your own name and you're earning between $37,000 and $80,000, and that investment earns some income, you're going to pay tax at, well, if you include the Medicare levy, you're going to lose over 1/3 of that money, because if you have the Medicare levy of 1.5%, you pay tax on the earnings of that investment at 34%. So depending on what your marginal tax rate is, paying tax on earnings at 34% is not particularly good. If you're on a higher taxable income, you might pay less. More tax. If you're on a lower taxable income, you might pay no tax at all with this tax-free threshold of $18,200. As I will talk about later, the actual tax-free threshold is about $20,500 because of the low income tax offset. So if you're earning income less than $20,500 this financial year, you'll pay no tax. You can also invest in joint names, and the income is just split between the two of you, but you might end up paying marginal tax rates as well. You can invest in a trust, and I have a number of clients who do this because they can distribute income to children, but also to their church prior to paying tax, and that is a beneficial structure if you have significant assets and potentially you're a fair way from your preservation age, and therefore can't access your superannuation. Companies are generally not that good to invest growth assets in because you pay a flat rate of 30%, and on capital gains you don't get any discounting, whereas if you hold the money in your own name, in joint names, a trust, or in super, you get a discount if you hold the asset for longer than 12 months in terms of capital gains. Now, just with superannuation, now super is divided into 2 phases: the accumulation phase, where you're putting money into super, and the a pension phase, where you're drawing money out of super. When you're in the accumulation phase, any earnings within the fund, so this is money you've got in super currently that's not in pension phase, pays tax within the fund of 15% on the earnings. So if you've got $100,000 in your fund and it earns a 10% return, I know that would be nice in today's environment, but a 10% return or $10,000 would pay 15% tax or $1,500 in tax. Now, if you're in the pension phase of superannuation, which it can be if you've reached your preservation age, you pay no tax on that money at all. So that's one of the strategies that we'll talk through later, moving your money from accumulation phase to pension phase to ensure that you pay no tax within your superannuation.